Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carrillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carrillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carrillo. Today we have Chris Larsen. Chris began syndicating deals in 2016, has raised more than $12 million, and has been actively involved in over $150 million worth of real estate acquisitions. He is the founder and managing partner of Next Level Income, through which he helps investors become financially independent through education and investment opportunities. So thank you so much for being on the show today, Chris.
Charles, thanks for the opportunity. Excited to be here.
So what was your background? You've been involved in a number of different fields. So what was your background prior to starting to invest in real estate?
Well, I was racing bikes. So I started investing in real estate when I was 21 years old, Charles. 1999, I was in college. Raced bicycles starting at age 14. And I read about this in my book, which if any of your listeners want to get it, they can check it out at our website, nextlevelincome.com/book. I'll send them a free copy. But to kind of highlight some of the things, I was racing bicycles, and I don't know, for anybody that knows about the cycling world, they know that it doesn't pay very well, even if you're a professional, even if you're a high-level professional, actually. So I wanted to race my bike. I wanted to have different options, and I was introduced to the concept of compound interest in investing by the same family friend, Clint Provenza, who introduced me to cycling. So I started my Roth IRA as a freshman in college and started learning about different investments. Ultimately, I started day trading. And while I was in college as a junior, I was making sometimes $5,000 a month day trading. This was in the late 90s. And then some months I was losing that or more. And as I sometimes laid awake at 3 a.m. in the morning thinking, what am I going to do tomorrow here with my trades? I thought, is this really how I want to spend my life? And, what if these numbers were multiplied by 10 or 100 times? And I was, instead of 20 years old, I was 40 years old. So I looked at other investing options. I'm pretty risk averse by nature. I tell people I don't bet. I only bet on sure things. And as I started to look into different options, real estate really bubbled up to the top. My parents were small real estate investors. They had a few rental properties, so I kind of knew about the concept. But my stepfather, my father passed away when I was 5. My stepfather was a contractor, so he'd do all the work. So that really wasn't that appealing to me. But from an investing perspective, it became appealing. So I bought my first property, age 21, bought another property, and from then on built a portfolio. And I did, as I mentioned in my book, a bunch of different things, ultimately culminating in the multifamily space in 2013. So I started investing in 2013 in multifamily, formed my partnership with now my former partner in 2015, and we syndicated our first deal in 2016.
Nice. So you primarily syndicate properties. Tell us about your first couple real estate investments that you got involved with, what they were, and how you made money with them or lost money.
Yeah. So I've been fortunate in my real estate career that I think we've made money on every deal that we've been in. Now, if you mark those deals during a certain time, some of those deals haven't been great, but over the lifetime of the deals, they've all made money. Our first investments were in single family, so bought a single family rental and what we now call like house hacking. Mm-hmm. I rented out 2 of the 3 bedrooms in the townhouse that I bought in college. And I bought the place next door. It was another 3 bedrooms. So it was essentially like I had my own little 6-bedroom apartment complex, and then continued from there. Then after our rental portfolio, we started buying distressed debt. So that's probably the space, if you look at our portfolio, we have individual loans that we had on that distressed debt that sometimes we got blown out of from a creditor order, but as a whole, we made money on that portfolio, and that was a good space to be in, kind of coming out of the Great Recession, where we were able to buy debt sometimes 9 cents on the dollar, and then it doesn't take a lot to get back to that.
What type of properties were those? Those were all single.
So those were single family. Okay. So what we were doing, Charles, is we were buying portfolios of seconds, non-performing seconds, and my partner was working those out.
Oh, nice. Yeah. So currently, with what you guys are focusing on, what are the markets you guys are targeting, and what is your traditional buying criteria?
Yeah. So, The reason I started in the multifamily space was because of the demographic trends. So I like to follow big trends. I like to follow tidal shifts. I don't like to day trade anymore, and I don't like to bet on short-term moves. I like to bet on long-term moves. So the multifamily space, we focus on that because of what I believe are strong trends that are going to continue through this decade. Started last decade, going to continue through this decade. I talk about the four trends, and those include millennials are renting, baby boomers are renting, immigrants are renting, high income earners are renting. We like to focus on high growth areas of the country. So for us, that's the Southeast. I personally moved from the DC area to North Carolina in 2008 because of the growth trends. So I moved here, moved my family, or started my family, moved my career here for those reasons. And today we focus on the Carolinas, we focus on Florida, Georgia, Texas, and all of our properties have been, as far as the multifamily space, in those areas. We own workforce housing, value add deals starting in the 70s, all the way up to our current acquisition, which is 2014 or 2013, 2014 built, 232 unit complex. So that would be a Class A deal. Yeah. So what we're looking at today, Charles, is light value add, B plus, sometimes A, depending on the market, properties that are typically 200 units or more in, again, those high growth areas, typically in the Southeast.
So for your mention of four trends, you've been involved in other different commercial properties in asset classes. What is it really because somebody has to rent? Is that why you're really focused on multifamily, or are you guys interested in any other asset classes currently for syndicating?
90% of what we do is multifamily. So we do have some partnerships in the commercial office space, the self-storage space, as well as the oil and gas space, which is actually particularly exciting right now with the price of oil plunging. It was below zero if you look at the spot price the other day. It's pretty crazy. But yeah, so again, I like multifamily as the cornerstone of my portfolio. I'm very transparent with investors. I say, hey, this is what I do with my money. And 80% of our portfolio is in multifamily. And that is because even if you look at, we're in the middle of the COVID-19 crisis right now, people have to live somewhere, and they typically are going to pay their rent as one of their first bills, if not their first bill, maybe behind groceries. So it's a very stable asset class. And, drilling down again, why, we kind of target different areas at different points in the cycle. We tend to look at the previous market cycles and look at what was strong, what was more stable during those points. And I think multifamily, I call it the Holy Grail in my book. I call it the Holy Grail because personally, I believe the risk-adjusted reward that you get, the risk-adjusted return in multifamily is the most appealing out of any asset class, in my opinion.
Yeah, for sure. I was talking to people about when we had multifamily in 2006 to 2009, and people are like, well, did you have problems? I'm like, no, we just weren't doing huge rent increases. You were increasing rent inflation. You know what I mean? If,
right. Yeah.
What that was at that point. But it was, it was just I never had issues with long-term delinquencies or anything like that. So, and it wasn't A class, it was C class, C plus stuff. So that workforce housing, as you said, that you're looking at sometimes or previously in the 70s. But you've raised over $10 million for your real estate investments. Can you explain a little bit about starting? So a new person starting to raise private capital, what they should do or how they would go about that?
Yeah. So we're up, I guess, probably about 15 million right around now. And very, very thankful for our group of investors in the trust. So I think, if I was to go back and either give myself advice or talk to somebody, like you said, that's looking to raise capital for deals, I think you need to, one, look to yourself first. Would you be comfortable putting money in those deals? I invest in every deal that we syndicate. So, I can tell investors, listen, I'm putting my own money here. I'm putting my family's money here. So I think you need to, there's really three things you need to look into. One, you need to look into the operator that you're working with. Do they have a track record? Do you trust them? Do they understand the space that you're going to invest in with them? Two, we talked a little bit about this, Charles, the market. Are you comfortable with the market? And then three, are you comfortable with the actual asset, the actual deal size? And you should be able to be very, very comfortable when going into that. Also, if you're going to raise money, I think you need to be able to show an expertise in some of that space. I've been investing for over 20 years in multiple different things. I don't invest in multifamily in the Southeast just because that's what I do in the Southeast. This was very purpose built. So I think, if you're going out and you're saying, "Hey, Charles, this is an opportunity we have. Would you like to invest alongside of us here?" You should be very comfortable with the rationale and the operation side, as well as the analysis side of that deal. The flip side is, if you're an operating partner in that deal, I think that's very strong too. If you have experience on the operation side, maybe you've managed properties before, maybe you have a construction background. Like one of my partners on the operations side has an underwriting on the insurance side background, and he owned a construction company. So, when I take Brandon into a property and walk through it, he's very comfortable working with the contractors. He's very comfortable looking and knowing the costs. He's very comfortable sourcing, different products and different pieces for the value add component. So, pick what you're good at, pick what you understand, focus on what you can add value for your potential investors in that space. And then again, I'd say, my advice is put your money where your mouth is. And, if you're talking to somebody that is bringing you a deal, I would ask those same questions to them as well.
Yeah, for sure. It's very important to pick when you're building your team to find out exactly what your specialty is, and then have people round out the rest of your team with stuff that maybe you don't like or you're not good at, which kind of go hand in hand. But when I speak to passive investors, one of the first things I hear about stuff that they don't like about investments they have or operators they work with is the lack of communication. What do you see for your investors? I imagine some of them have invested with other operators as well. What do you see as stuff that they didn't care so much for, or issues they had with previous investments?
That's a great point, and I think it's very, very appropriate to ask that question now during times of great uncertainty, Charles. So, I was on an interview yesterday, and we were talking about like what we are doing now that's a little different, and my answer was we're over communicating. So. What we say at Next Level Income is we put investors first through education. That's our first thing. And communication is a big part of education, especially if you're talking about current deals. So we have a monthly update that goes out, whether we're doing monthly distributions or quarterly distributions. We have a monthly update that goes out. What we've done during this period is we've actually increased that to a weekly update for investors. Hopefully investors appreciate that. I think once a week is an appropriate level of communication. We're not bombarding, our investors with a ton of irrelevant data. We try to be very to the point and do that. And we probably should have brought this up when we were talking about what advice do you have. I think, the important thing that you can do is communicate to investors, tell them where we are in the market, tell them what's going on, especially if they have their money with you. You want to let them know, whether it's good news or bad, what's going on. Because the worst news, I say it's akin to being in a dark cave without a flashlight. The fear of the unknown is what creates anxiety.
Yeah, for sure. It's keeping in touch with people that have invested through you. And then also in this time as well, it's keeping in touch with people that you owe money to, in the sense of like, we've been on open lines of communication, which I imagine you have as well, with lenders. And just letting them know, hey, our collections are this, everything's fine at this point, everything's going well. And just let them know that, you just don't want to be, hey, you haven't paid, you don't want that call saying, hey, are you paying the mortgage or what's going on or anything like that. So it's open lines of communication, I think, on both sides.
No, that's another great point. And, what I did, we have a property here in Asheville downtown. We have 7 units in that property. It's a commercial property. Four of those units, the businesses in them were shut down by the health department. The week before that happened, I went to them and I said, hey, how are things going with your business? Are you affected yet? Things at that point were going reasonably well, but everybody kind of knew what was happening. Things were starting to slow down. People were canceling appointments, like in a hair salon, for instance. And I said, look, keep me in the loop. Let's work together through this. I didn't make any promises, But when the health department shut them down, I had already contacted my bank, and just like I was able to work out a solution with my tenants in the bank that helped everybody. And I'm in the middle, so this is a challenging time for landlords and property owners and operators. But we worked out something that's manageable for everybody. So I think there's a good example of that in practice.
Yeah. So for what kind of examples of common mistakes you see from real estate investors, whether they're new or whether they're seasoned of some sort? What do you think?
Yeah. So, kind of not following the advice that I was talking about before, not like properly evaluating those risks. I think, new investors, they kind of look and say, hey, what does this deal look like? But I always tell investors, they call me, they say, hey, walk me through this deal. I say, well, let's take a step back and talk about why we're in this market, why we're in this space, and why right now it's what I feel to be a good time to be in that before we look at the deal. So I always kind of train investors to walk through that process themselves. When it comes to the operations side, I think this is a great time. If we think about who is going to be getting in trouble during this period, there's three rules that I think are good to follow if you're an owner and operator. One, when you buy a property, buy cash flow properties. If you have a cash flow property today, I had cash flow properties as you did, going through 08, 09. I didn't make a tremendous amount of money during that time on the properties that I owned prior to the crash, but I didn't lose any money, and they all cash flowed positive through that. And that's kind of brings to the second point, which is have long-term debt. So if you have long-term financing that's stable, so if you had to sell or refinance a property today, that may be a problem for you, especially if you have a hotel or a retail space. It may be a challenge for you. If you have debt that's going to hold through a period that you foresee your value add process or your operations going through, then you can ride out these periods and not be a forced seller. We always like to say, we don't like to be a forced seller. We like to be opportunistic on the buying as well as the selling side. And that brings me to the third point, which is have adequate reserves. So all our properties have, 7 figures of reserves for the most part. 6 to 12 months is good. It's like I write about, I have a little short part in my book, and, I don't go a ton into personal finance, but I think it's great to have, an emergency fund if you're an individual. And, 3, 6, 12 months. I personally like to have, a year's worth of expenses set aside as an individual. I think it's great to have 6 to 12 months set aside. So, those are where I see the mistakes. People, kind of blindly following the near-term trends, not realizing that real estate goes through cycles, not having the appropriate debt, not having appropriate reserves into a space, or, betting heavy on, a speculative construction deal or something like that. That might not go bad. Those or might not go well. Those are some of the things that I saw people really get blown out on 10 years ago, and I imagine people that are doing that are going to face some pain today.
Yeah, I think the reserves is a huge thing that's not, obviously it's going to be tightening up more, especially with all the agency debt, Fannie and Freddie. Yeah. But right now, I think in the next 6 months, you're going to see people over this whole year doesn't have the reserves, or it's going to come out. And because before you didn't need that much, and now it might be double, it might be triple, right? They're saying even 18 months of mortgage and interest. So it's, that's quite the amount of additional money you have to raise, but it's also the amount of security for your investors. You're not going to be calling them back and saying, hey, capital call, we need more money. It's not operating how we thought. So, but,
and I've had capital calls in deals I've been invested in, and that's, when you have a property or a deal that's not going particularly well, and again, that's an example of a deal that we made money on, but there were periods that didn't go well. So, when you have a deal that's not going great, and then the operator calls you and says, hey, Chris, can you send us a check so that we can keep this deal going? In some ways you think, man, I'm throwing good money after bad. It'd be a lot more comfortable to have those returns scaled back a little bit. And, I'd rather look at a deal and say, hey, what if these returns were a third lower? But I'm not going to get a capital call. I'd be more comfortable with that deal than a deal that really stretches and says, hey, we're going to, show you exceptional returns, but, everything has to go perfectly.
Yeah. For some of the passive investments that I'm involved with, some of the operators have come back and they've said, well, we're just going to hold off on sending out the pref stuff, which I'm totally fine with. I'd rather hold off, weather the storm, have more money than less, make sure everything gets paid, everything's done, everything's rented, and then start at that point once we're coming up on the upswing of this to start sending out prefs. If there's additional return that was from before, that's great. If not, then it's just what it is. You'll pick it up when you sell the property or refinance.
Exactly.
So, well, it's great. How can our listeners get in touch with you and learn more about you and your company?
Yeah. So easiest way is to go to our website, charlesnextlevelincome.com. I'm doing a free book giveaway right now during the COVID crisis. So all you got to do is go to our website, nextlevelincome.com, click on the book link. You can get a free ebook right away, or if you put your address in, I'll send you a copy. You can click around there, follow me on LinkedIn, social media. I try to put educational material up every day on our website. And again, you can also check out our podcast.
Yep.
I really appreciate what you're doing for your listeners here. We love educating individuals on financial matters and helping them on their way to financial education. And what you're doing is a big piece of that, Charles. So I really appreciate having me on.
Yeah, thanks, Chris. And looking forward to connecting with you in the near future. Have a great day.
Likewise. Thank you so much.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Harborside Partners Incorporated exclusively.